Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The solar industry continues to be an attractive industry for investors, especially now that the market is in much more mature phase than it was in the 2010s. We basically know how companies are going to compete with each other, what sort of place in the market they're going to stake out. So that gives us an opportunity to buy stocks that can expand their existing position in the market long term. And there are three that I think are really appealing right now. That's what I want to go over today. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And the first stock I want to cover today is First Solar. This is one of the better known companies in the solar industry. So no surprise that this stock is on the list. But what I really want to focus on is the expansion that the company has coming down the pipeline. You can see here that there are four major expansions for First Solar: a facility in India, which will be operational later this year, two coming online next year with an Ohio expansion, and then the R&D facility. And then in Alabama, there's another facility expected in 2024 or 2025. Probably expect that more like in 2025. So what does that do for First Solar? Well, this is the company's expected backlog, and management has said that they're sold out for a couple of years now. So 71.6 gigawatts of solar panel sales that they have. And the potential bookings are another 72.6 gigawatts. This is the one that I always look at here, is the mid to late stage opportunities. So the company's future looks really bright given the backlog and the potential growth there. But I want to touch on that we haven't really seen the results from those expansion plans. You can see in the most recent quarter, $548 million in revenue, only $43 million in net income. So the company is profitable. That is a good sign. And they're starting to sell off or eliminate some of the development projects, which go into these kind of up and down margins that you see for the fourth quarter of 2022. The balance sheet also continues to be really strong. $2.3 billion in cash on the balance sheet. This is guidance for the full year. So the end of 2023, management expects about $3.5 billion worth of sales, cash on the balance sheet to be $1.2 to $1.5 billion. And that's on volume of 11.8 to 12.3 gigawatts. And very profitable, $7 to $8 per share in earnings. So you can expect that will likely increase pretty significantly as some of these expansions come online. And really what First Solar is doing is just building on the momentum that it has in thin film solar. So they have a different solar panel construction than a lot of their competitors who are making the silicon panel. And they've really gotten to the point where they can sell this into certain markets very profitably. And there's a lot of demand, particularly in the US. This is the biggest US solar manufacturer. So getting a lot of the benefits from some of the recent subsidies that the US has put in place. I just think there's a lot of momentum behind First Solar. The stock may continue to be a little bit volatile, but that's to be expected in this industry. The second stock is SunPower. This is a company that has gone through some massive changes over the last 5 or 6 years. It is now a residential solar company, primarily providing technology and design services to its third-party partners. So there's not a lot of cases where SunPower is actually owning the trucks, if you will, although they're starting to expand in that as well. But oftentimes what they're doing is they're working with a third party that's actually doing the installation, but they'll have SunPower branding on their trucks and they'll work directly with SunPower as a dealer. But SunPower's real value add is in building the infrastructure behind that. So the tools that are used to bid projects, the financing, lining up equipment, and designing systems that can be placed on roofs in a very simple manner and installed in a very simple manner. So that's really the value that they're adding. And then the physical labor goes into those dealers, and that's where they get their margin. But you can see here a couple of metrics from the most recent quarter. Backlog continues to increase, and the company targets over $3,000 in adjusted EBITDA, a proxy for cash flow from each installation. There was some negatives in the most recent quarter because they were trying to get some installations in place in California before some of the net metering rules changed. So there's a little bit of volatility there. That's sort of the one-time decline. But you can see here that for the year, they're still expecting 90 to 110,000 new customers, and revenue continues to increase. Like a lot of companies in the residential solar space, SunPower is also doing what they're calling a virtual power plant. This is something that has been talked about for a long time. But basically, they'll aggregate together a whole bunch of energy storage systems in people's homes and sell that energy back to the grid, sharing some of that benefit with those homeowners. So basically makes the energy storage system that can be included with a rooftop solar installation, makes that a little bit more valuable, adds both incremental value to SunPower and also adds value to their customers. A few key metrics here in this slide. I mentioned the declining margins from a adjusted EBITDA standpoint, but management did stand by guidance for the full year of $2,450 to $2,900 in adjusted EBITDA. A couple of big changes here on the bottom. Net recourse debt, $281 million a year ago, now just $77 million. That's in large part because they sold a huge stake in Enphase Energy. That's something they've been doing for quite a while and has been a real help in reducing the debt on the balance sheet. But there is $270 million in net retained value, so calculated value, that is on the balance sheet long term from a partnership known as Armstrong. So that's a leasing business, basically finances a lot of the leases that SunPower has. And SunPower retains some of that value. This is a calculation that they're giving for that. I wouldn't put a lot of stock into this number, but there at least will be some value in that net retained value number. And then you can see here for the year, expecting adjusted EBITDA to increase from $95 million a year ago to $125 to $155 million. That's a pretty significant increase. And for a company that's trading with a market cap of about $1.8 billion, like I said, doesn't have much in the way of debt on the balance sheet. That's a reasonable valuation, especially if they can get to this target model of $3,000 to $4,000 in adjusted EBITDA per residential solar installation. A lot of tailwinds behind residential solar, and I think SunPower, given its structure, the fact that it's not taking a lot of the financial risk on its own balance sheet, that's the reason that this is the stock that I think investors should be looking at most closely. The final stock I want to look at is Hannon Armstrong. Hannon Armstrong is a company that finances renewable energy projects in a number of different spaces, including a partnership with SunPower. But it's really a diversified way to be on the finance side of renewable energy and solar in particular. So they'll do things like buy land under a wind farm or a solar farm. They will buy the residential solar assets that are on rooftops and have contracts to collect revenue from customers for 10, 20, 30 years. So a little bit different than the first two companies we covered, but the numbers are pretty solid here and investors are getting a pretty good dividend of 5.8% right now. Management just affirmed their 10 to 13% annualized distributable earnings per share growth. So that's money that they could give back to investors, and said that they'll actually grow the dividend 5 to 8%. For a dividend that's already 5.8%, that's a pretty solid growth rate. One of the things I like about Hannon Armstrong is the ability to get into new markets before other competitors on the finance side really take notice and start to compete. So here's some examples of what it's invested in on the solar side: commercial and industrial solar, residential solar over $90 million, public-private partnerships, energy efficiency, community solar $40 million. So lots of these rooftop solar panels that you see across the country, they're going to be financed by companies like Hannon Armstrong. And that's really where the company's dividend and where its growth comes from. As the solar industry continues to grow, this is a market that needs some of these critical pieces like solar panels that are going to be producing the electricity that is ultimately sold to customers. They're going to need the companies that install solar panels on roofs, and also the companies that finance all of these projects. That's where these three companies, First Solar, SunPower, and Hannon Armstrong, fit in the value chain. That's why I think they're in a really great position. The stocks have been beaten up a little bit recently, but I think that gives a good buying opportunity for investors that are willing to hold long term and allow these companies to grow into what they're going to become. That's why I'm bullish on all three. What do you think? Leave your comments in the comment section below. Love to hear your thoughts. Don't forget to follow Asymmetric Investing. Thanks for watching, everybody. See you here next time.